Welcome to the Personal CFO. Today let's talk about inflation. I've been getting a lot of great questions and you've seen plenty of news covers that's talking about the potential increase in inflation and how it may or may not impact your investments moving forward. So let's invest a few minutes, look back on history and see what it tells us we can expect in the future. This chart goes back about 100 years and it gives us the average rate of return given any rate of inflation, or given several rates of inflation, all the way from really low inflation at the top to higher inflation down at the bottom and everything in between. And what you see pretty quickly is in the middle, the returns are pretty good. Double digits, 10%, you're doing quite well with average inflation. Maybe a little higher, a little lower. To give you context, we're right in the middle at about 2.5%, maybe a bit higher right now. And what you might also notice is on the ends, really low inflation, as in below 1%, or negative, which is deflation, all the way to the bottom bar, which is 5% plus, all the way to double-digit inflation. Things don't look so good. All of a sudden, you're in the low single digits for average rate of return in the market. And really all it means is the market does not like the extremes when it comes to inflation, whether it's deflation on one side or much higher inflation on the other. And where we are now at 2.5, maybe a little bit higher, we're right in the middle. So, the news is going to cover a lot, but based on where we are now, it doesn't look like we're on one of these extremes that could link directly to a detrimental stock market. Now, again, no one knows, but just looking back at history, here's where we are, right down the middle. Now, moving past the stock market for a minute, I want to talk about something that I think is just as important, if not more important, as far as how inflation may impact your asset classes. And those two asset classes are bonds and cash. And the good news is we don't have to look back at 100 years worth of statistics in order to figure out, is it good or bad for those assets? So I want to do some easy math, and we'll just use bonds because it's the same math as cash. And we'll use the 10-year Treasury bond, which right now is about 1.5%. And if inflation is 2.5, and you're getting 1.5 rate of return, what that means is when you buy a 10-year Treasury bond, you are effectively signing up and saying, I want to lose about 1% of my purchasing power every year for the next 10 years, if that makes sense. So you're earning 1.5, but you're losing 2.5 to inflation for 10 years. That means you've lost 10% of your purchasing power over that time, which is not a great thing to sign up for. And cash is no better. If anything, it's worse because, as you know, cash rates are lower, but the math is still the same. Just subtract inflation from your current return that you're getting, and that is what's happening to your purchasing power. Now, why is this important is when you're thinking about your financial planning and your retirement income planning, you most likely want your income going up over time, at least keeping your purchasing power consistent so you can do the same things that you've been doing. And that can be difficult with certain types of assets in an environment where inflation is not really low. So going back to stocks, inflation is about average right now. The extremes are usually when you see the market not react well to really high or really low inflation. But what's really important to keep an eye on right now is bonds and cash and how you're allocating to those assets to protect your purchasing power over time. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.